Hello all of you. Now let's see the chapter of payment of tax, another small theoretical chapter, weightage again around 4 marks. Okay, so let's see. Section 49. One question you can expect out of this. Payment of tax, interest, penalty and other amounts. So first section deals with payment. When do you have to make the payment? And how do you have to make the payment? Very simple one. We have already known all these points. Payment can be made out of your electronic credit ledger or electronic cash ledger, and the payment due date is the return itself, GST R3 or 3B as the case may be. Yes, that is 20th of the next month. So all these points are given here again. Then every deposit. Okay, so now we'll see the electronic cash ledger in detail. So when you actually deposit the amount to the credit of the government, that is when you make payment through your bank to the government, that first of all goes into your electronic cash ledger. So the amount that you pay to the government is credited to your electronic cash ledger. Okay, and then when you actually make the payment of tax, it is debited to your electronic cash ledger. So that's given there. That every deposit, first you make deposit towards tax, interest, penalty, fee or any other amount by the person by internet banking or by use of credit or debit cards or national electronic fund transfer, that is NEFT or RTGS, or by such other modes and subject to conditions and restrictions as may be prescribed. So you can make payment to any other mode as well. Normally you use this internet banking, RTGS, NEFT or credit card, debit card, right? Shall be credited to the electronic cash ledger of the person to be maintained in such manner as may be prescribed. So we'll see the rules. Prescribed means as per the rules. Nothing different. It will be just credited to your electronic cash ledger. Then input tax credit as self-assessed in the return of a registered person shall be credited to his electronic credit ledger. ITC is credited to our electronic credit ledger. Everyone knows this. In accordance with section 41, we had seen in ITC chapter. Then the amount available in the electronic cash ledger may be used. Small 2-mark question can be used for making any payment towards tax, interest, penalty, fees or any other amount. Any amount payable under the provisions of this act or the rules made thereunder. So question may come that what payments can be made out of electronic cash ledger. So we'll say tax, interest, penalty, fees or any other amount. But what can be paid out of electronic cash ledger? Any amount. What can be paid out of electronic credit ledger? Only tax. Remember, the balance in electronic credit ledger, that is ITC, can be used only for payment of tax, not for interest, penalty, fees or other amounts. Okay, means interest, penalty, fees or other amounts can be paid only through cash ledger and not credit ledger. Understood? Very important point to remember. So that is first point. And then subsection 4 says that the amount available in electronic credit ledger may be used for making any payment towards output tax only tax. Okay, under this act or under the IGST act. So that means that CT, ITC, input tax credit of central tax, can be used to pay central tax or integrated goods and service tax, that is IG. Okay, under this act or under the IG, in such manner and subject to such conditions and within such time as may be prescribed. So these points we already know, right? We have studied all these points in ITC chapter itself. Then comes subsection 5. This is about the set off of credit. Okay, so which tax? We have got CGST, we have got SGST, we have got UTGST and we have got IGST credits. So these are the 4 types of credits that we have. Now let's see which credit can be used to pay which type of tax on our outward supply. Okay, very good and very interesting and very important point. Question can come on this. So it says the amount of input tax credit available in the electronic credit ledger of the registered person on account of number 1, integrated tax IT shall first be utilized. In short, I am writing IT, it is IGST, shall first be utilized towards payment of integrated tax, means the same type of tax, and the amount remaining, if any, may be utilized towards payment of central tax and state tax, or as the case may be, the union territory tax, in that order. Means what you have to do is, let me explain in the this is the ITC available. It's a very simple point, but you have to remember, and we have studied this I think in ITC chapter also. So if the credit is of IGST, then it can be set off. Set off means utilized against priority wise. First IGST. If the balance remains, then the second priority is of CGST. The third priority is of SGST, and on the fourth priority will be UTGST. Okay, so this is how the priority will be set for IGST, credit of IGST. Then coming back, second is central tax. So if the credit is of CT, central tax, shall first be utilized towards payment of central tax, and the amount remaining, if any, may be utilized towards payment of integrated tax. Means if the credit is of CGST, then it can be utilized first towards CGST, and if any amount remains, then against IGST. Okay, but here I'll also write one point, SGST and UTGST, and then strike it off. Means CGST credit cannot be used to pay SGST or UTGST. So this is a very important point which you should remember at all times. So it can be used only for two purposes, to pay CGST or to pay IGST. Then next is state tax. State tax means the ST we can write, shall first be utilized towards payment of state tax, and the amount remaining, if any, may be used towards payment of integrated tax. Means again ST, and if any amount remains, then IT, provided that the input tax credit on account of state tax shall be utilized towards payment of integrated tax only where the balance of input tax credit on account of central tax is not available for payment of integrated tax. Now what this means, let's see. Firstly, it says that if the credit is of SGST, then it should be used to pay SGST, and if amount remains, so first priority is of SGST, second priority is of IGST. But again, if there is central goods and service tax payable or UTGST payable, then it cannot be set off. Okay, so SGST credit cannot be used to pay CGST or UTGST. So likewise, we have seen about the CGST credit cannot be used to pay SGST, and SGST credit cannot be used to pay CGST. Now, one more point is there in SGST as far as the IGST set off is concerned, that if I have balance, if I've got say IGST credit of 100, CGST credit of 200, and SGST credit of say another 200. So I've got total credit of 500. Okay, and I have got IGST payable of say 410. So which credit I will set off and in which order? First I will set off IGST credit of 100. First priority will be IGST. Second, I will set off CGST. So both CGST and SGST can be set off against IGST. That is true. But first priority will be of CGST. So I'll write here second, means second set off will be of CGST 200. And then the remaining will be SGST. So how much is remaining? 110. So out of 200 of SGST credit, I will use 110 to set off against IGST payable. So this will become nil and the credit will remain, remaining credit of 90. This we can carry forward. Understood? Simple. Then coming back, so that was third point. Then D says that union territory tax. So this is similar to state UT, absolutely same. Union territory tax shall first be utilized towards payment of union territory tax. It's the same union territory tax, and the amount remaining, if any, can be used to pay integrated tax. Provided that input tax credit on account of union territory tax shall be utilized towards payment of integrated tax only where the balance of input tax credit on account of central tax is not available for payment of integrated tax. Same to same. So no need to write. Okay, same to same as state tax. Then E point says that the central tax shall not be utilized towards payment of ST or UT. This also we have written already in the chart. And state tax or union territory tax shall not be utilized towards payment of central tax. This also we have written. So all the points are simple. Okay, so as we have seen this, let us revise this once again, that ITC available and set off against. So if ITC is of IGST, then you can set off in this order: IGST, CGST, SGST, UTGST. If the credit is of CGST, then you can set it off first against CGST, and then if balance remains, then IGST. But you cannot set off against SGST or UTGST. Similarly, if you have credit of SGST, you can set it off first against SGST and then against IGST if the balance remains, but cannot set off against CGST or UTGST, right? And we took this one example also, that if IGST payable is there, then first you have to set off the IGST credit, then CGST credit, and then SGST credit, right? This is good. Now let me take another point from reverse side, that is, if payable is CGST, I have to pay CGST of say 500 rupees, and I have got credit of all IT, means integrated tax, CT, ST as well as UT. I have got all the credits with me. I have got IT credit of 200, I have got CT credit of 600, I have got ST credit of maybe 300, and UT credit also of 100. Then the point is that which of these credits can be utilized first to pay CGST? Out of these, which credit should be used first? Interesting point now. So for this, let's see two other sections which are inserted by the Amendment Act of 2018 and one Rule 88A that was inserted later on. So let's see. Come back. So this was subsection 5 that we are seeing. Now skip 6, 7, 8. We'll come back and see them later. Come back ahead. You will find two new sections, 49A and 49B. So let's see what these sections say. 49A says utilization of input tax credit subject to certain conditions. Notwithstanding anything contained in 49, so this overrides 49, right? So means it overrides 49.5 that we saw just now. The input tax credit on account of central tax, state tax or union territory tax, on account of central, state or UT, shall be utilized towards payment of IT or CT or ST or union territory tax, as the case may be, only after the input tax credit available on account of integrated tax has first been utilized fully towards such payment. So what it says? That first you have to utilize the integrated tax credit fully, exhaust the credit of integrated tax, and then you can use the CT, ST or UT as the case may be. So what it means? It means that in this example, if I've got CGST payable and I've got credits of all these four, the first one, since I've got IT credit available with me, I have to exhaust this. So first priority of set off will be IT. First I'll set off IT of 200, so it will become nil. When it becomes nil, then I can use the CT credit. So second I'll use the CT credit of the balance 300 out of 600. So this will become nil. Understood? And if, for example, let me make it a little more complicated. This was 200. Let's make this as 100. So if my CT credit is only 100, then I can set off only to that extent, right? Only to the extent of 100. So here my set off will be 100. Then the question comes that can I set off the ST credit? I've got 300 credit. Can I set off? Or the UT one? No. ST and UT cannot be used to set off against CGST, means to pay CGST, right? So this is the maximum credit that I can set off, 300, and 200 will be payable in cash. Okay, understood the point? Very simple. So what 49A says that first you have to exhaust integrated tax credit. So even though my liability is of CGST, I cannot set off CT first. I have to set off IT first, and then I can set off CT for the balance amount. Understood? And if suppose the CT is more, means if IT credit is 200 and CT credit is 600, as I took in the original example, and CT CGST payable is say 700. So first I'll set off IT of 200, then I will set off okay, then I'll set off CT of 500. So this becomes nil, right? And out of this 600, 100 will be carried forward. Balance 100 will be carried forward. Understood? Simple. Then let's take one more example. If I have got IT payable, integrated tax, means IGST, okay, payable of 1000, and CT payable of another 600, and my credits are ITC available is IT 1300 and CT of 900. Then what I'll do, how to set off? First you have to exhaust IT, right? You have to exhaust IT. But since my credit is IT and my output is IT and CT, so which will be set off first? IT. So out of 1300 I'll set off 1000 here first. So this will become nil. Then the balance of 300 will be set off here. So this is set off of IT credit. First 1000 rupees against IT, then the balance 300 against CT. And then this CT will be used to pay the balance of 300. And the balance will be carried forward. So how much balance remains? 600 will be carried forward. Understood? So you have to remember from both sides that if I have got IT credit, where can I set off first? Against IT, then CT. Okay. And if IT and CT are both payable and I have got IT credit as well as CT credit, then IT credit has to be exhausted first. So you pay IT out of IT, then you pay CT out of IT to the extent possible, and then pay CT out of CT. Got it? Interesting. Then let's take another example. I have got IT payable of 1000. I have got CT payable of another 1000, and I have got ST or UT also payable of another 1000, and the credits are IT 1600, CT credit of 800, and ST credit of another 800. Haha, interesting. So first priority will be IT. You have to exhaust IT completely. So let's see, less IT credit. So I've got 1600 credit. So out of that 1600, which tax I'll pay first? I'll pay IT first of 1000. So first payment will go towards IT. Then balance 600 remains. So now the question is that this balance 600 of IT credit which remains will be used to pay CT first or ST first, or any combination. Part this, part that. Can I use part, or how should I pay? Will it be used to pay CT first compulsorily? So as we saw in section 49, let's come back. Don't write this, I'll give you time later on. So as we saw in section 49, what it said, the first point, that integrated tax shall first be utilized, 495A, first be utilized towards payment of integrated tax, and the amount remaining, if any, may be utilized towards payment of central tax and state tax, or as the case may be, union territory tax, in that order. See what it says, in that order. In that order means you go like this: central, state, union territory, in that order. Means 495A says, and this whole 495A is also amended by the Amendment Act of 2018, and these amendments have come into force with effect from I think 15th of Feb 2019. So this is with effect from 15th Feb 2019. So when this amendment came and they said in that order, it means that in our case, if you come back to our case, then I have to pay the balance 600, means use the balance 600 towards CT, because I have to go by this order. first IT, then CT, then ST. So what happens because of this? Just understand, I don't write. So I set off 600 here, okay, of IT, and then nothing will be left to set off against ST because 1600 is gone completely. Okay, then I will use CT credit. So CT credit now can be used against CT only, and the balance CT is 400. So out of 800 I can pay 400 out of there. Okay, and balance carry forward 400. So out of 800, 400 will be used, 400 will be carried forward. And of course CT cannot be used to pay ST. Then I have got ST credit, so that will go here of 800 and payable will be 200. So payable in cash will be 200. Now there came a problem. See, the problem is that CT credit is carried forward 400 and here I am paying 200 in cash. So even though I have got credit there, but here I am paying 200 in cash. That's the problem. Means cross set off is a problem. However, if the government would give me the leeway, means the choice of setting off the 600 of IT. IT can be used to pay CT also, IT can be used to pay ST also. If government would have given me an option to pay CT or ST as the case may be, means in any order, then what I could have done is I would not have set off 600 here. I would have said, because I have got credit of 800 of CT which can be used to pay this 1000, so I need only 200. No, I need only 200. So I would have set off only 200 here, and then the balance 400 I could have used against ST. So here I could have used 400 balance. Okay, so if this would have been in my hands, right, as a choice, I could have set off 200 and then here I would have set off 800. CT full 800 I would have used, so this would anyways become nil, and here I would have used only 600 and this would also have become nil, and then this was fully utilized. Out of this 800, 200 would have been carried forward. ST credit of 200 would have been carried forward, right? So here the payable would be 0 now, so this would be beneficial to the assessee. But because of the Amendment Act, subsection 5A was amended and it said in this order. So because of that, the problem is that we are paying this 200. So then the government realized, after making this amendment, they realized that there is a problem. So to solve that problem, they have introduced a rule 88A, which we are going to see. But before going there, let's see this 49B also. 49B says order of utilization of input tax credit. Notwithstanding anything contained in this chapter and subject to provisions of E and F of 49.5. So firstly it says notwithstanding anything, means this also has an overriding effect over the whole sections, that is section 49 basically, but subject to E and F. Subject to E and F means that government cannot override E and F of subsection 5 of 49. E and F is a restriction on cross utilization, that is CT cannot be used to pay STUT, STUT cannot be used to pay CT. So that restriction will continue. Okay, government cannot override that. But apart from that, government may, on the recommendation of the council, prescribe the order and manner of utilization of input tax credit on account of integrated tax, central tax, state tax or UT tax, as the case may be, towards payment of any such tax. So it says that government can prescribe the order and manner of utilization, and whatever is prescribed under 49B by way of a rule or a notification, will override 49.5. The rule which will be prescribed under this section will override. So that is 88A, which they have prescribed, overrides 49.5, and more so A, though not restricted to A, but I am writing example A, or you can say A, B, C, D. A, B, C and D. These can be overridden, but not E and F. Okay. So A said follow the order. IT should be used first towards IT, then CT, then ST. Follow that order. But now 49B gives the power to the government to prescribe a different order. Okay. So they have done it under 88A. So let's see. Let's go further. We'll come back and see the other rules later on. But right now come down to 88A. Yes, here is 88A, which has been inserted by notification number 16 by 2019 with effect from 1/4/19. So this is a later notification and it overrides 49.5. This overrides 49.5. Okay. So what it says, order of utilization. Input tax credit on account of integrated tax, credit of integrated tax shall first be utilized towards payment of integrated tax. That's true. And the amount remaining, if any, may be utilized towards payment of central tax and state tax or union territory tax, right? As the case may be, in any order. See what it says, in any order, not in the same order, in any order. Interesting, right? So this rule 88A has solved our problem. Understood? It says any order. So therefore, okay, read the proviso also, then we'll go back to our problem and then you can take it down. Provided that the input tax credit on account of central tax, state tax or union territory tax shall be utilized towards payment of integrated tax, central tax, state tax, union territory tax only after the input tax credit available on account of integrated tax has been fully utilized. So this was given in 49A also, same as 49A. Okay, so that is continued. You have to first exhaust integrated tax credit and then you can use the other credits. Okay, so coming back to our problem, so this solution that we had given logically is now prescribed in 88A. So I don't have to set off this 600 fully here. I can set off in any order. So I will use 200 here and 400 here. So this logic is correct. It is as per 88A. Okay. So I'll rub it off and then write it again. So understood? So there is some planning involved here. Okay. So what we'll do is we'll use this IT credit of 1000 here. First IT against IT. Then you can use it, the balance 600 you can use against CT or ST as per your choice in any order. So you can divide also. When they say any order, you can divide it also. So I will use 200 here because I have got 800 credit of CT itself. Okay. So I'll use only the balance. But we have to use it first. You have to use IT first. So I'll use 200. Keep 800 balance so that I can use CT credit also. And the balance 400 we will use against ST. So now IT credit is exhausted. Full 1600 is gone. 1000, 200, 400 fully gone. Very good. Once it is fully gone, or you can take another ratio also. You can take 300, 300 also. But you have to exhaust full 600. Okay. So you can take 200, 400. You can take 400, 200. You can take 300, 300. Anything will do. Anything will do. But you have to use it fully. So once IT is fully utilized, then we'll use CT and ST to the extent possible. So all the three will become nil. So payable in cash is all nil, and out of this ST credit of 800, 600 is gone, so 200 will be carried forward. And if we would have used this 300 here, then what would happen? Then we would use 700 of CT and ST, so 100 balance will be carried forward. So that is mathematical calculation, that is up to you. Now you take down. Interesting one na? Very interesting. So pause it and take it down, and then I'll give you another theoretical this thing, that if payable is IT and CT and STUT and the credit is of IT, then first priority will go to IT and second priority will go to CT or ST in any order. So you can use it to pay ST also, you can pay CT also, you can divide it and pay both. It's up to you. And that will depend upon how much other credit we have got of CT or ST, as the case may be. But you have to exhaust it first. Okay, you have to exhaust. Once full credit is exhausted, IT, then use CT. So CT can be used first against CT, and if balance remains, then you can pay IT, but not STUT. Similarly, you have got STUT, then first you have to pay STUT, and then if balance remains, you can use against IT, but not against CT. Understood? So this is our final conclusion. Take it down and always remember. Right? So pause it, take it down, and then come back to the lecture. Then the balance in the electronic cash ledger or the credit ledger after payment of tax, interest, penalty, fees and so on and so forth may be refunded in accordance with provisions of 54. So this we'll see later on in the chapter of refund. Write down chapter of refund. There are a lot of conditions attached there. It is not that whatever is the balance will be refunded to you as it is. No. There are a lot of conditions. So those conditions we'll see in the chapter of refund. Then all liabilities of a taxable person under this act shall be recorded and maintained in electronic liability register as may be prescribed. So you have to maintain a register called as electronic liability register, in which you will mention all the payment details, all your liabilities, that is output, then reverse charge, then tax. Apart from tax, there will be penalty, interest and so on and so forth. So everything will be recorded in electronic liability register. Then every taxable person shall discharge his tax and other dues under this act or the rules made thereunder in the following order, namely self-assessed tax and other dues related to returns of previous tax periods. Means if there is some outstanding dues of preceding periods, we'll have to first set off that. Then self-assessed tax and other dues relating to current tax period return, the return of the current tax period. Then any other amount payable under the act or the rules made thereunder, including the demand determined under section 73 and 74. 73, 74 are recovery sections. That is called as recovery of short levy, non-levy. earlier there was some mistake and there is a short levy and the department initiates an action against the assessee to pay that tax, then we have to pay that also. Then every person who has paid the tax on goods or service under this act shall, unless the contrary is proved by him, be deemed to have passed on the full incidence of such tax to the recipient of such goods or service or both. This is a deeming fiction. It's a deeming fiction, very important deeming fiction. This is called as a deeming fiction of indirect taxes. That is, the burden is deemed to have been shifted. Once you pay this tax, the burden is deemed to have been shifted to the recipient. Like, for example, I collected fees from you and I've paid the tax to the government. So it is deemed that I have passed on the burden to you, the consumer. Then, for the purpose of this section, the date of credit to the account of the government is the authorized bank shall be deemed to be the date of deposit in the electronic cash ledger. As soon as they deposit the money in the electronic cash ledger, it will be deemed to have been credited to the government. Or vice versa, you can say. The date when the amount is credited to the government will be deemed to be the date of deposit in the electronic cash ledger. And the expression tax dues means the tax payable under this act and does not include interest, fee and penalty. Whenever I say tax, it means only the basic tax, the IGST, the CT, the ST, the UT. It will not include the other dues like interest, fees, penalties, etc. And other dues means these. So these will be called as the other dues. Tax dues means tax. Other dues will cover all these other things, interest, penalty, fee or other amounts. Okay. So very simple points. So 1 or 2 points to be remembered out of this first section. One is the utilization of credits that all of us of course know. And that's it. 1 or 2 simple points. Then comes the rule. So first rule is for electronic liability register. Now you have to just, in the rules you have to just see the form numbers basically. So it says the electronic liability register shall be maintained in form GST PMT1. PMT1. Okay. For each, PMT stands for payment. PMT1. For each person liable to pay tax, interest, penalty, fee and so on and so forth. The electronic liability register of the person shall be debited by the amount payable towards tax, interest, fee and other dues. The amount of tax, interest, penalty or any other amount payable is determined by the proper officer. So one is as per the return. As per the return means voluntarily, which we show as tax payable. Then as determined by the proper officer in pursuance of proceedings under the act. And the amount of tax and interest payable as a result of mismatch. Mismatch we had seen that if the returns of the supplier and the recipients don't match, then it is added to the liabilities. So that one under section 42, 43 or 50. Or any amount of interest that may accrue from time to time. Any interest that may accrue. So even the penalties, the interest, everything, every kind of payment that you are liable to make is entered in the liability register first. It is debited to the liability register. Then subject to provisions of 49, payment of every liability by a registered person as per his return shall be made by debiting the electronic credit ledger maintained as per rule 86 or the electronic cash ledger maintained as per 87, and the electronic liability register shall be credited. So the payment entry will be these registers debit, electronic credit ledger or cash ledger debit to the liability register. Okay. And the amount deducted under section 51, next point says amount deducted under section 51 means we are the assessee and somebody, the government, has deducted our tax. We have given some services to government and while making payment to us, government has already deducted tax. and deposited it with the government. Though I haven't explained this point to you, right, up till now. So don't worry, we'll see this point in this chapter itself after some time. So the amount deducted under section 51. Now if you don't have any clue in GST about TDS, just think of income tax. In income tax, what happens? That if I give a CA service to a company, then company, while making payment to me of the audit fees, deduct the tax at source. So what I do is, I take that TDS and set it off in my self-assessment return, right? So similarly it will happen here, that the amount deducted under section 51 or the amount collected under section 52 or the amount payable on reverse charge basis RCM or the amount payable under section 10, that is composition, or any amount payable towards interest, penalty, fee or other amount under the Act shall be paid by debiting electronic cash ledger maintained under Rule 87, and electronic liability register shall be credited accordingly. So basically what point number 4 says, that all these amounts, TDS, TCS and everything else apart from tax, can be paid only through electronic cash ledger. That is what it means. You cannot pay these amounts out of your credit ledger. Even the composition tax has to be paid by electronic cash ledger, because you don't get credits. When you are in composition scheme, you don't get input tax credit. Then fifth point says, any amount of demand debited in the electronic liability register shall stand reduced to the extent of relief given by the appellate authority or the appellate tribunal or the court, and the electronic tax liability register shall be credited accordingly. So what it means, that if suppose a demand was raised, assessing officer raised a demand of 20 lakhs. So we debited it to our liability register, but at the same time we went into appeal also. In appeal, that 20 lakh demand is reduced to only 6 lakhs. Means 14 lakhs is remitted by the court, reduced. So what I'll do is, I will credit that 14 lakh to my electronic liability register. And now the balance will stand at 6 lakhs. Simple. Then the amount of penalty imposed or liable to be imposed shall stand reduced, partly or fully as the case may be, if the taxable person makes the payment of tax, interest and penalty specified in the show cause notice or demand order, and the electronic liability register shall be credited accordingly. Now this point you will not understand like this. Just write down, refer to section 73, 74. So in these sections we will see these points. What happens is that if you make payment within a particular period of time, your penalties are reduced or sometimes even waived off. So that is what is given there. So if you make payment of tax and interest and the reduced penalty within a specific time, then your penalty can be reduced or waived off. So the amount by which the penalty is reduced will be credited to the electronic liability register. Credited means that my liability will reduce by that extent. Okay. So this we'll understand in section 73, 74. And lastly it says, a registered person shall, upon noticing any discrepancy in the electronic liability register, communicate the same to the officer exercising jurisdiction in the matter through the common portal in GST PMT 4. So any discrepancy has to be notified, informed. So that was the liability register. Now comes the electronic credit ledger. Credit ledger means in which we take the input tax credit. So that is also very simple. The electronic credit ledger shall be maintained in PMT 2 for each registered person eligible for input tax credit under the Act on the common portal, and every claim of input tax credit under the Act shall be credited to the said ledger. Now this I have already explained in ITC chapter. Right, when we receive the inputs in our factory or premises, and we are entitled to take the input tax credit on the same, what we do is we credit that much amount to our electronic credit ledger. And again, for your understanding, I would repeat one point, that in my accounts, financial accounts, I will actually debit it to my electronic ledger if I maintain ledger by this name, that is GST account. So I will debit it, like I purchase inputs of 10,000 and there is 1800 rupees of GST on it, so total payment is 11,800 to the supplier. How will I make an entry? In my books of accounts, purchase account debit 10,000, GST account debit 1800 to the supplier's account 11,800. But this electronic credit ledger is a government record. Remember, this is a government's record. This is not my financial statement. This is government record. So in government's record, what I'll do is I will take credit. So therefore it is given that input tax on your inputs and input services and even capital goods will be credited to the electronic credit ledger. This is government's record. Okay. Then when we utilize, so this is also called as availment of credit. Availment of input tax credit, ITC. Okay. Then utilization is by debiting. So it says, second point, the electronic credit ledger shall be debited to the extent of discharge of any liability in accordance with provisions of section 49. So this is what? This is utilization of credit. This is utilization. So the liabilities means the tax on my outputs will be debited. Then where the registered person has claimed refund of any unutilized amount from the ECL in accordance with provisions of 54 that we'll see later on, the amount to the extent of claim shall be debited to the said ledger. If you are claiming refund, then obviously you will have to reduce the balance now. So you have to debit it to electronic credit ledger if you are claiming refund. Now who is given refund, that we'll see in section 54. So one thing I'll explain you, because the fourth point you will not understand without this. Now what happens is that when I claim the refund, that is when I file the refund claim, say I am filing a refund claim of 38,000 rupees, I have to debit my electronic credit ledger by 38,000 at that time itself. That time means when I am claiming the refund. So when I file a refund claim of 38,000, I'll have to debit my electronic credit ledger by 38,000. Means I cannot utilize that much credit later on. I've reduced my credit by 38,000 and then I file a refund claim. What if the refund is given to you full 38,000? Then it's fine. If you get refund of 38,000, then it's fine. But if you get refund of lesser amount, the government approves only 20,000 refund. So then what will happen? Then the balance 18,000 which I have debited to electronic credit ledger on account of anticipatory refund, but I don't get it, I will recredit it to my electronic credit ledger. Simple. So first I debit 38,000 and then I wait for the government to refund me the amount. If they refund me 20,000, that is 18,000 less, then this 18,000 will be recredited again to my electronic credit ledger. I will reclaim that much credit. So that is given in the point number 4. That if the refund so filed is rejected, either fully or partly, sometime it may also happen that the full refund is rejected. So then I will take full 38,000 back into ITC, back into electronic credit ledger. Wholly or partly, the amount debited under sub-rule 3 to the extent of rejection shall be recredited to electronic credit ledger. Simple. Then, save as otherwise provided in the provisions of this chapter, no entry shall be made directly in the electronic credit ledger under any circumstance. Means apart from these entries, no other entry can be made. Simple. And the registered person shall, upon noticing any discrepancy in his electronic credit ledger, communicate the same to the officer exercising jurisdiction in the matter through the common portal in form PMT 4. That's also simple. An explanation says, for the purpose of this rule, it is hereby clarified that a refund shall be deemed to be rejected if the appeal is finally rejected, or if the claimant gives an undertaking to the officer that he shall not file an appeal. That's also technical in nature, of no use. Then comes electronic cash ledger. Cash ledger is for cash payments. So very simple one. The electronic cash ledger under 1 of 49 shall be maintained in PMT 5. Form number is PMT 5 if you want to remember the forms, otherwise not necessary. Shall be, for each person liable to pay tax, interest, penalty, fees and so on and so forth on the common portal for crediting the amount deposited, and debiting the payment therefrom. So when you deposit the money, it will be credited to the electronic cash ledger, and when you make payment of taxes or interest or penalty or any other sum, it is by way of debit to electronic cash ledger. So debiting the payments, crediting the deposit and debiting the payments. And any person or person on his behalf shall generate a challan in PMT 6 on the common portal and enter the details of the amount to be deposited by him towards tax, interest, penalty, fees or any other amount. So PMT 6 is the deposit form, or we can say a challan. Provided that the challan in GST 6, PMT 6 generated at the common portal shall be valid for a period of 15 days. So it will be valid for 15 days. So what happens is that you have to first go and create a challan. This is the actual payment procedure. How do you deposit tax? So if you have worked in your offices on GST, you will know this point. Otherwise, it's very simple. First you have to go on the portal, log in with your credentials, your user ID and password, and then you have to generate a challan. You have to make a challan in which you will fill all the details for the month and the amount and the name of the assessee, the GST and number, all those things you have to enter, and then pay. So payment is to be done within 15 days. So first you generate a challan. This challan will be valid for 15 days, means within 15 days you have to actually make the payment. Then provided further that the person supplying online information and database access or retrieval services OIDAR from a place outside India to a non-taxable online recipient referred to under section 14 of IGST Act may also do so through the board's payment system, namely electronic accounting system in excise and service tax, from the date to be notified by the board. So they will also be allowed to deposit the tax. That's simple. Then the deposit shall be made through any of the following modes: internet banking, credit card, debit cards, then NEFT or RTGS, or over the counter payment. Over the counter payment means cash deposit. But how much? How much cash will be accepted by the government? So it says through authorized banks for deposit up to, underline, 10,000 rupees per challan per tax period, by cash, check or demand draft. So this is called as over the counter payment. Over the counter payment means there are designated banks, you can go there and make payment. So whether you take a check, whether you take cash, whether you take a demand draft, whatever, it will be accepted only up to 10,000 rupees. So if your liability is less than 10,000, then you can go and make payment over the counter. But if your liability is more than 10,000, then you have to make payment by internet banking, not across the counter. So that basically means government wants to avoid payment over the counter, because they know there are department officials who are sitting on the counter will somehow be mismanaged. Therefore they say that no physical interaction. You deposit online itself. Then there are two provisos. first proviso says provided that the restriction for deposit up to 10,000 rupees per challan in case of over the counter payment, as we saw that over the counter payment can be made only up to 10,000, shall not apply. So this restriction of 10,000 shall not apply to deposit made by the government departments or any other deposit to be made by persons as may be notified by the commissioner in this behalf. So first exception is for the government department itself. Government also has to pay GST in various cases. So if the government itself is paying GST, then they can make any amount over the counter, and such other persons as may be notified by the commissioner. Second, proper officer or any other officer authorized to recover outstanding dues from any person, whether registered or not, including recovery made through attachment or sale of movable immovable properties. So this is a case of defaulters, Vijay Mallya case. Now Vijay Mallya has run away. Who will pay his GST liability? So it will be recovered by sale of his assets. So if the proper officer sells off the assets of Vijay Mallya and recover the amount and deposit it, that can be deposited over the counter. Number 3, proper officer or any other officer authorized for the amounts collected by way of cash, check or demand draft during any investigation or enforcement activity or any ad hoc deposit. So if the recovery is again through investigation or enforcement procedure, then that can be taken. This is like whatever we get, because the person is defaulter. So let's recover anything from him, anything which we can recover. So these two processes are for that. So one is recovery proceedings and one is investigation or enforcement proceedings. Then provided further that a person supplying OIDAR service from a place outside India to a non-taxable online recipient in India, right, referred to in section 14 of IGST Act, may also make deposit under sub-rule 2 through international money transfer through Society for Worldwide Interbank Financial Telecommunication Payment Network from the date to be notified by the board. Didn't get anything now? Leave it. What it means is that you can do money transfer from outside India to India. It's simple. Then for the purpose of this sub-rule, it is hereby clarified that for making payment of any amount indicated in challan, the commission, if any, payable in respect of such payment shall be borne by the person making such payment. See, every payment that we make through online system, like internet banking is free, but if we make payment through RTGS and etc., then some charges are levied by the banks. So these charges will be borne not by the department but by you, the assessee. You have to bear the charges for online transfer. Like even credit card fees, debit card fees, that has to be borne by the taxpayer, not by the department, not by the government. Then any payment required to be made by a person who is not registered under the Act shall be made on the basis of temporary identification number generated through common portal. That's also simple, because they don't have a GSTIN number because they are not registered, so a temporary identification number will be granted to them. And where the payment is made by way of NEFT or RTGS mode from any bank, the mandate form shall be generated along with the challan on the common portal, and the same shall be submitted to the bank from where the payment is to be made, provided that the mandate form shall be valid for a period of 15 days from the date of generation of the challan. This is RTGS payment. There is a mandate form for that. Then on successful credit of the amount to the concerned government account maintained in the authorized bank, a challan identification number, SIN it is called as, shall be generated by the collecting bank, and the same shall be indicated in the challan. So the date will be mentioned there. and the CIN, CIN. Then on receipt of the challan identification number from the collecting bank, the said amount shall be credited to the electronic cash ledger of the person on whose behalf the deposit has been made, and the common portal shall make available a receipt to this effect. So finally a receipt will be given to you, and the amount will be credited to your electronic credit ledger. Then where the bank account of the person concerned or the person making the deposit on his behalf is debited, but no challan identification number is generated. The amount is debited to your bank account. Okay, it means withdrawn from the bank account, but no challan identification number is generated. Sometimes it happens now, electronic mismatch happens. Then what you have to do is, or is generated but not communicated on the common portal. Suppose it is not generated, or if generated it is not communicated, then the said person may represent electronically in PMT 7 through the common portal to the bank or the electronic gateway through which the deposit was initiated. So you have to then pursue the matter with the bank or the electronic gateway like PayPal, PayU, etc. An amount deducted under section 51 TDS or collected under 52 TCS and claimed in form GSTR2 by the registered person from whom the said amount was deducted, or as the case may be collected, shall be credited to his electronic cash ledger in accordance with Rule 87. This we had seen in past lectures. So the TDS or TCS, suppose your TDS is collected by the government or TCS is collected by the ECO, the electronic commerce operator, and they have given you the what we can say, the TDS certificates, TCS certificates, and you have claimed it in your GSTR2, then that will be also credited to your electronic cash ledger. Then where a person has claimed refund of any amount from electronic cash ledger. Now as we saw for the credit ledger, same thing applies for cash ledger. If you are claiming any refund out of this, you have to first debit the cash ledger by that much amount. And if the refund claim is rejected wholly or partly, then you can take the credit back. Simple. So first, while claiming the refund, you have to debit the electronic cash ledger. If you are allowed that amount, very good. If not allowed and rejected, then you have to reclaim the credit. Simple. Simple point. Shall be credited to the electronic cash ledger by the proper officer if the amount is rejected. And the registered person shall, upon noticing any discrepancy in his electronic cash ledger, communicate the same to the officer exercising jurisdiction in the matter through the common portal in PMT 4, and it will be resolved. And the refund shall be deemed to be rejected if the appeal is finally rejected. One explanation. And second explanation says that for the purpose of this rule, it is hereby clarified that a refund shall be deemed to be rejected if the appeal is finally rejected, or if the claimant gives an undertaking to the proper officer that he shall not file an appeal. You give a declaration that you will not file an appeal, then it will be deemed to be rejected. So you can take back the credits. Then identification number to each transaction. One small rule is given there, that a unique identification number shall be generated at the common portal for each debit or credit to the electronic cash or credit ledger, as the case may be, and this UIN relating to discharge of any liability shall be indicated in the corresponding entry in the liability register. Simple point, nothing to remember. Then the complete analysis is given, so I will not read it again. That is given to you for your self-study. All the points we have already discussed. But you have to go through it once. Okay. Electronic cash ledger, electronic credit ledger. And the common points and the manner of utilization, all these points we have seen. Tax liability register, right up to presumption. Then come to interest. Interest is also simple. Interest on delayed payment of tax. Now we have discussed this section also many times before. 18% and 24%. There are two interest rates. The normal interest rate is 18% in case of delays, and if it is a case of fraud, etc., then it is 24%. So see, every person who is liable to pay tax in accordance with provisions of this act or the rules made thereunder but fails to pay the tax or any part thereof to the government within the period prescribed shall, for the period for which the tax or part thereof remains unpaid, pay on his own. Interest is voluntarily. Interest is to be paid on own volition, okay, by yourself. Self-assessment. Interest at such rate not exceeding 18%. So the section gives the rate not exceeding 18% as may be notified by the government on recommendation of the council. And what is the rate notified by government? 18% only. So they have notified the highest rate, 18%. Then the interest under one shall be calculated in such manner as may be prescribed from the day succeeding the day on which tax was due to be paid. So if the due date is say 20th, the interest will start from 21st till the date of payment. And a taxable person who makes an undue or excess claim of input tax credit under subsection 10 of 42, this we had seen, or undue or excess reduction in output tax liability under subsection 10 of 43 shall pay interest on such undue or excess claim at the rate not exceeding 24% as may be notified by the government, and government has notified here also 24% per annum. So government has for the time being prescribed the highest rates, that is 18% or 24%, and that notification is given here. Notification number 13 by 17. So for the purpose of subsection 1 of 50 it is 18%, subsection 3 of 50 it is 24%. And then interest rates for refund is also given here in the same notification. So we'll see here and we'll see these sections later on. This is 12 of 54 for refund. When you make a claim for refund and if there is a delay in refund, the government will give you interest at 6% per annum. This is the reverse case. Government gives you interest at 6% per annum. Then section 56 and proviso to section 56, 6 and 9. This is also, all these three are refunds. Then analysis is given. This is also simple. No need to study. And interest has to be paid by yourself. Simple. So here we'll take a break, and in the next lecture then we'll see two interesting things, the TDS and the TCS provisions.